Okay, a few quick comments on asset quality across market cycles. And this video is going to be for more intermediate level investors who can read a balance sheet, can sort of differentiate profitability and quality levels across companies in an industry, and who are maybe interested in learning more about market timing, learning about cues that the stock market can give us to help us make decisions to put more money into stocks or take money out. So one thing to know is that there's often a transition of the types of companies that outperform based on where we are in the cycle of a market, in a bull market or a bear market. So, for example, say in the middle innings of a bull market, say the third or fourth inning, let's say, you're going to generally see the best quality companies do better. They're going to be the ones that are outperforming, whereas the lower quality assets are going to underperform in general. And what happens is there's a transition as you get later and later into a bull market cycle where things get frothier and frothier and they're getting a little more manic. You start to see a shift in the asset quality. You start to see the lower quality companies start to outperform and the higher quality companies become laggards. They start to underperform. And that's a cue. That sort of indicates, okay, it's getting a little later in this bull market cycle. And then very late in the bull market cycle, you might see real shit companies, real shit stocks doing very, very well. And so a textbook example of this was the 1990s, the late 90s tech boom, where you had some very, very low quality companies with no revenues, no profits, maybe no prospect for any profits, but these stocks were outperforming dramatically. And it was just a very, very good indicator that things were getting out of hand and it was time to sort of back away from the stock market. Okay, and then there's one other example, very salient example, that sometimes you see during the whoosh down, kind of the worst days of a market sell-off or a market crash, where, like for example, during the 2008-2009 great financial crisis, on some of the worst days, you saw the highest quality companies underperform, which is counterintuitive, but what happens there is typically the marginal player who's moving the market. At those days or those times, it's usually a leverage player that has to sell anything that they can to make good on debts. Maybe they're leveraged, they've got margin debt, whatever the case is. And so in those cases, you have to sell the good in order to fund the bad. So during whoosh down periods, during really bad market environments, you can't even get a bid on low quality assets. You can't sell it at any price. But a high quality asset, you can sell almost at any time. So the Cokes, the Berkshire Hathaways, the really, really high quality companies, you can always sell. And when those situations happen and you've got to sell the good to fund the bad, these players get shaken out of very, very high quality companies. The stocks decline a lot, and that can be a signal of opportunity for you because you can now buy these high quality assets at very discounted prices. So these are two instances where you can get some relatively high probability cues about where we are in a market cycle, and it can help you make a decision as to putting more money in or taking money out of the stock market. So it's helpful for market timing. As always, I hope these videos are helpful, and thanks for watching.